Something is happening in the gold and silver markets right now that almost nobody is connecting the dots on. And I'm not talking about inflation. I'm not talking about the Fed. I'm not talking about debt or deficits or any of the usual reasons people bring up when they talk about precious metals. I'm talking about something that sits at the exact center of the biggest financial story of our generation, something trillions of dollars are pouring into right now, and it is quietly doing something to gold and silver that almost no one in mainstream finance is willing to say out loud. The thing I'm talking about is artificial intelligence. Now stay with me, because I know how that sounds. You came here to learn about gold and silver, not tech stocks. But by the end of this video, you are going to see something that changes how you look at both, permanently. Because the same machine that is making NVIDIA the most talked about company on the planet is creating a demand shock underneath gold and silver that is completely invisible to most retail investors. And there's a second part to this story that is even bigger. Because AI is not just consuming precious metals, it is also quietly destabilizing the financial system in a way that sends people running toward the oldest form of money on Earth. Two forces, one trigger. And right now, the pressure is building in both directions at the same time. Gold is currently trading around $4,424 an ounce. Silver is sitting near $66. Both metals are climbing toward multi-week highs after a brutal summer of volatility. And central banks around the world just purchased 244 tons of gold in a single quarter, their highest pace in years. At the exact same time, most retail investors are busy staring at chip stocks. Those institutions know something. And in the next 20+ minutes, I'm going to show you exactly what it is. Before we go any further, if this kind of deep dive research is what you come here for, hit that like button right now because it tells me to keep making videos like this one. Subscribe if you haven't already, because this channel is built on one idea: taking the real story that's hiding underneath the financial headlines and breaking it down in plain English. No hype, no doom, just the machine, explained clearly. And here's my question for you before we dive in. Drop your answer in the comments and I read every single one. Do you think AI is a tailwind or a threat for gold and silver, and why? There's no wrong answer. I want to hear where your head is at before we go through this together. Section 1. The part nobody is saying out loud. Let me start with something that sounds strange. The technology that is eating the world, artificial intelligence, runs on silver. Not in the way your phone runs on silver, not in small amounts. In enormous, structural, unavoidable amounts. Here's what I mean. Silver is the best conductor of electricity of any element on the periodic table. It's roughly 7% more conductive than copper. It doesn't form insulating oxide layers the way aluminum does. In any application where you need reliable, high-current electrical flow, in environments that cannot fail, silver is the default engineering choice. It's not the flashy choice. It's the necessary one. Now think about what an AI data center actually is. Every large AI data center consumes between 50 and 500 megawatts of electrical power. That electricity flows through an enormous web of infrastructure: main switchgear, power distribution units, automatic transfer switches, uninterruptible power supplies, busway systems, relay contacts. And silver is embedded in the critical components of all of it. Industry analysts at the Silver Institute and Metals Focus estimate that data center silver demand now sits at 20 to 40 million ounces annually as of 2026, with projections of 40 to 80 million ounces annually by 2030 under aggressive AI build-out scenarios. Let me put that in context. Total global silver mining production is roughly 820 to 850 million ounces per year, and we're talking about one end market, AI infrastructure, that is growing at 15 to 25% annually, adding tens of millions of ounces of new demand to the ledger every year, with no realistic ceiling in sight because the AI build-out is nowhere near complete. But here's where it gets even more interesting. Because data centers aren't the only industrial consumer of silver right now. Silver is simultaneously being consumed at record rates by solar panels. Each standard solar panel uses approximately 20 grams of silver in its electrical contacts, and the IEA projects solar capacity additions exceeding 500 gigawatts in 2026, which translates to more than 100 million ounces of silver demand from solar alone. Add electric vehicles, add 5G infrastructure, add medical equipment, and then stack AI data centers on top of all of it. Add EVs, high-efficiency semiconductors, 5G, and the massive electricity load of AI data centers, and silver becomes one of the few industrial metals whose demand curve steepens every year. There isn't a real substitute. Every attempt to replace silver in these applications has failed or resulted in inferior performance. This is the part that changes the story. Industrial demand remained the largest single category of silver consumption in 2025, accounting for approximately 59% of total global demand at 665 million ounces. And the fastest growing slice of that industrial demand, the slice that did not exist at meaningful scale 5 years ago, is AI infrastructure. The silver market was already running a structural deficit before the AI boom. Demand was already exceeding mine supply by roughly 160 to 200 million ounces per year. The AI buildout didn't create that imbalance, it deepened it. And it did so in a way that is almost impossible to quickly resolve, because silver supply is largely a byproduct of copper, zinc, and lead mining, which means silver production decisions are made on base metal economics rather than silver prices. You cannot quickly spin up a silver mine in response to AI demand. You cannot substitute away from silver in these applications without a meaningful performance penalty. And the demand is not going away. It is growing because every new server generation, every additional rack of GPUs, means more power electronics, more precision contacts, more silver. The deeper the global economy penetrates into an AI-supported, electrically powered future, the more these metals move into the foreground as strategic bottleneck factors. So that's the first half of the story. AI is physically eating silver, and the market hasn't fully priced that in yet. And if that were the whole story, it would already be significant. But there's a second layer here that I think is actually more important, and almost no one is looking at it. Stay with me. Section 2. Gold, the AI bubble's inevitable destination. Now let's talk about gold. Because gold's relationship with artificial intelligence is completely different from silver's, and in some ways, it's more alarming. Gold is not being consumed by AI in meaningful industrial quantities. Gold's role in this story is not about conductivity. It's about what happens when the financial infrastructure around AI starts to crack. Here's the setup you need to understand. The AI boom is one of the largest capital spending cycles in the history of the global economy. The leading AI companies are spending hundreds of billions of dollars building data centers, buying chips, and building out infrastructure. That spending requires financing, enormous amounts of it. And the way some of that financing is being structured is beginning to raise serious questions in the bond markets. Not from gold bugs, not from doom YouTubers, from the actual debt traders, the quiet, serious people whose entire job is to price risk accurately. Here's the specific thing I want you to pay attention to. When the cost of insuring a company's debt against default, something called a credit default swap, starts rising sharply while the company's stock is simultaneously at all-time highs, the bond market is telling you something. It is telling you that the paper market enthusiasm and the risk assessment are moving in opposite directions. The stock crowd is throwing a party. The bond traders are quietly buying fire insurance. That divergence, when the people celebrating and the people pricing risk are reaching opposite conclusions, is historically one of the clearest warning signals in all of finance. Now zoom out from any single company and look at what this AI spending cycle is doing to the broader financial system. The World Gold Council's 2026 Central Bank Gold Reserve Survey found that a record 45% of central banks now plan to increase their gold holdings over the next 12 months. That is not a marginal shift. That is a structural reallocation by the world's most price-insensitive buyers, institutions with 50-year investment horizons. These are not retail investors chasing momentum. These are governments, and they are moving into gold at a pace that has not been seen in decades. Central banks globally added a net 244 tons of gold to their reserves in the first quarter of 2026, marking a 17% increase from the previous quarter and a 3% increase year-on-year. The People's Bank of China completed its 20th consecutive month of net gold purchases in June 2026, acquiring 15 tons in that single month. China imported more than 700 tons of gold in the first 5 months of 2026 alone. Now, ask yourself a simple question. Why are the institutions most responsible for managing national reserves, the people who arguably understand the architecture of the global financial system better than anyone, moving this aggressively into gold at this exact moment? The motivation, as expressed by survey respondents, centers on gold's role as a long-term store of value, its performance during periods of crisis, its lack of default risk, and, increasingly, its function as a hedge against geopolitical risk and sanctions exposure. The freezing of Russia's foreign reserves after 2022 sent a message to every central bank on Earth. Assets held in someone else's currency, in someone else's financial system, can be made inaccessible. Gold cannot. Gold held in your own vaults is answerable to no one. And now layer on top of that the AI-driven financial engineering that is pumping hundreds of billions of dollars of new risk through pension funds and insurance companies, the same institutions that hold the retirement savings of ordinary people. Gold doesn't sit in anyone's financial system. It doesn't depend on any counterparty keeping their promise. It cannot be created by a central bank to paper over someone else's bad bets. And in an environment where the financial system is becoming more complex, more leveraged, and more dependent on a single technological narrative, that property becomes increasingly valuable. This is why Goldman Sachs raised its December 2026 gold price target to $5,400 an ounce earlier this year. Not because they're gold bugs, because their analysts looked at the structural demand picture, central banks, geopolitical fragmentation, debt sustainability concerns, and concluded that the tailwinds are not going away. Gold hit an all-time high of approximately $5,589 an ounce in late January 2026. It pulled back from there, down nearly 30% into June, as the Fed turned hawkish under Chair Warsh and the US-Iran situation temporarily eased. And now it's rebuilding, back near $4,424 as of this week, climbing on the back of a weak jobs report that missed badly. The economy lost 23,000 jobs in July against expectations of 80,000 gains, and a CPI reading that showed inflation still running 70% above the Fed's own target for the fifth consecutive year. That combination, a weakening economy and sticky inflation at the same time, has a name, and it matters enormously for what comes next. Section 3. Stagflation and the environment. Gold was built for. The word is stagflation, and I want to explain what it actually means because it gets thrown around carelessly, and the real definition changes how you think about gold and silver in a profound way. Stagflation is what happens when two things that normally can't coexist actually do. An economy that is slowing, even contracting, at the exact same time that prices keep rising. It sounds paradoxical. In a normal economic cycle, when growth slows, demand falls, and prices cool. That's how recessions have historically brought inflation under control. But in a stagflation environment, that correction doesn't happen. Prices stay elevated or keep rising even as jobs disappear, wages stagnate, and the economy weakens. It happened in the 1970s in America, and the data we are getting right now, in August 2026, is beginning to assemble the same picture. Weak jobs, sticky consumer inflation, producer prices under pressure, energy costs elevated by geopolitical factors that interest rate policy literally cannot fix, and a Federal Reserve internally divided. 3 of its own members voted for an immediate rate hike at the last meeting, even while the jobs data is cracking. That is a central bank caught between two bad choices. Raise rates to fight inflation, and you accelerate the damage to a weakening economy. Hold rates, or cut them, and you risk inflation becoming permanently entrenched. Now here's the part that matters for gold specifically. During the 1970s stagflation period, the last serious episode the United States went through, gold rose approximately 2,000% over the decade. Not because everything was fine, because nothing was fine, because the Federal Reserve could not easily fix what was broken, because the conventional tools of monetary policy stopped working cleanly. Gold does not need a perfect economy to perform. Gold needs an environment where the value of paper promises is being quietly eroded, where inflation is running faster than the returns on money kept in the bank, where the purchasing power of the currency is being taxed away slowly, invisibly, year after year. That is precisely the environment that the current data is pointing toward. And here's the thing. Even in the short term, even if the Fed raises rates aggressively and puts short-term pressure on gold by making bonds more attractive, the gold market has shown this year that it can absorb that pressure and keep climbing, because the underlying demand from central banks is structural. It is price insensitive. It doesn't stop because of a rate hike. The World Gold Council's annual Central Bank Gold Reserve Survey, published in June 2026 and covering 76 institutions, found that 89% of reserve managers expect global gold holdings to increase over the next 12 months. 89%. That is not a marginal consensus. That is an overwhelming structural commitment. Now I want to bring both of these threads together, the silver demand story and the gold safety flight story, and show you exactly how the AI trigger connects them. Because when you see the full picture, it becomes very clear why this is not a temporary trade. Stay with me. Section 4, where the two stories meet. Let me put the complete machine on the table because this is where it all becomes one story instead of two. Artificial intelligence is simultaneously creating a structural consumption demand for silver, a physical, industrial, unavoidable demand that grows with every new data center, every new GPU cluster, every new megawatt of AI computing capacity, and it is creating a systemic fragility in the financial system that historically drives people toward the safety of gold. The first effect is visible in the supply-demand numbers. Silver prices soared, trading between $65 and $95 per ounce in late 2025 into early 2026, a multi-decade high. And the reason isn't speculation. The reason is that you can't print silver. You can't conjure it into existence. And the industries that need it aren't slowing down. They're accelerating. The second effect is visible in the behavior of the smartest, most patient money in the world. Central banks don't panic. They don't chase momentum. They make 10-year decisions. And right now, on a 10-year horizon, 45% of them are planning to increase their gold holdings. That number has never been that high. Now let me give you the honest counter-argument because I think you deserve it. There is a real case for caution on both metals right now. For gold, when interest rates are elevated, bonds start paying you a real return. Gold pays you nothing. A world where treasury yields stay above 4.5% is a world where gold has to compete against an attractive alternative. That competition is real. It is why gold pulled back so sharply earlier this year. And if the Fed manages to bring inflation under control without crashing the economy, if we get the soft landing, gold's near-term performance will be more muted. For silver, it's an industrial metal. If the AI bubble unwinds badly, if the capital spending cycle reverses, silver absorbs that shock through two channels simultaneously. Its monetary role and its industrial role both get hit at once. Silver is more volatile than gold. It can fall faster and harder when the macro environment turns against risk assets. These are not hypothetical risks. They are real ones. And anyone who tells you the path from here is a straight line up is not giving you the full picture. What I can tell you is what the structural forces look like. And the structural forces are pointing in one direction. Demand for both metals is being driven by factors that are not going away in the next quarter or even the next year. The AI build-out is not slowing. The electricity demand of data centers is likely to increase by well over 100% by 2030 as large cloud providers expand their AI clusters. Each new server generation, each additional rack, means more power electronics, more highly reliable contacts, and therefore more precious metals. The geopolitical fragmentation is not healing. An unprecedented 90% of central bank survey respondents cited gold's historical performance during crises as highly relevant to their allocation decisions. And the U.S. national debt continues to grow in a way that makes the math of long-term sustainability increasingly difficult. The interest payments on the federal debt now exceed $1 trillion per year. The annual deficit is running near $2 trillion. The pool of reliable foreign buyers of U.S. treasuries has been thinning, and at some point, not necessarily next month, not necessarily this year, the bond market will demand a meaningful premium for the risk of holding a government IOU, and the chain reaction that follows will remind everyone why gold exists. Section 5. What to actually watch. Let me give you something concrete, because understanding without a watch list is just anxiety. The first thing I watch: silver's supply deficit numbers. The silver market has been in a structural deficit for multiple years in a row, demand exceeding supply by over 150 to 200 million ounces annually. That deficit does not resolve itself quickly. New silver mines take 7 to 10 years to bring into production. Watch the Silver Institute's annual demand report and monitor whether industrial consumption is tracking above or below prior year estimates. When the deficit is deepening, the floor under silver is real. The second thing I watch: central bank gold purchase volumes. The World Gold Council publishes quarterly demand data. Watch whether the pace of accumulation, currently running near 850 tons per year, holds, accelerates, or reverses. Central banks buying on price dips, as they did consistently through mid-2026, is the strongest signal available that the structural demand is genuine and not momentum-driven. The third thing I watch: the gold to silver ratio. Right now, 1 ounce of gold buys roughly 66 ounces of silver. The historical average over the last century is closer to 50 to 55. When that ratio is elevated, as it is now, silver has historically tended to eventually close the gap, often dramatically, often faster than people expect. A falling gold-silver ratio during a metals bull market is typically a signal that silver is catching up. Watch for it. The fourth thing I watch: the 10-year Treasury yield. If the yield on the 10-year climbs decisively above 5%, the competition against gold gets sharper. If yields fall, especially if the Fed cuts rates, the opportunity cost of holding gold disappears and the bull case strengthens materially. That 10-year number is the reference point for almost everything in this story. The fifth thing I watch: AI infrastructure capital spending announcements. Every time a major tech company announces a new multi-billion-dollar data center build-out, that is a silver consumption event. It doesn't show up in the silver price the next day. Industrial supply chains don't move that fast. But it adds to the structural demand picture that ultimately moves the market over months and quarters. Let me bring you back to where we started. Gold is sitting near $4,424 an ounce. Silver is near $66. Both metals are climbing in an environment where a weak labor market, sticky inflation, elevated energy prices, and a divided Federal Reserve are assembling the early building blocks of a stagflation picture. At the same time, the single largest technology investment cycle in human history is consuming silver in structural quantities that the mining industry cannot quickly match. And the financial engineering underneath that cycle, the debt, the circular financing, the risk parked quietly in pension funds, is driving the smartest institutional money in the world toward an asset that has no counterparty risk and cannot be created out of thin air. That is the AI trigger for gold and silver. Not because AI is bad, not because technology is doomed, but because the infrastructure that AI requires physically consumes silver at a growing rate. And because the financial system AI is being built on top of is creating exactly the kind of fragility that gold was designed to hedge. Nobody knows when the next big move happens. I won't pretend to know the date. The risk environment could stabilize. The Fed could thread the needle perfectly. The AI bubble could deflate slowly instead of suddenly. But the central banks of the world are not waiting to find out. They bought 244 tons of gold in a single quarter. China has been buying every single month for nearly 2 years straight, and 89% of reserve managers on Earth expect gold holdings to increase in the next 12 months. That is the clearest signal I can offer you about how seriously the smartest institutions in the world are taking this moment. You don't have to be a professional to understand what's happening. You just needed to understand the machine, and now you do. Drop your thoughts in the comments. Tell me, does the AI-silver connection change how you think about silver? And are you watching gold as a safety play, an inflation hedge, or both? I read every single one. And if this gave you a view of gold and silver that the mainstream headlines aren't giving you, subscribe, because this is the kind of research this channel is built on. Every week the story develops further. I'll be here walking through every turn of it.